All right, good afternoon, everyone. I'm pleased we could bring together so many different groups today for this presentation to understand how events are handled during the growing season year over year and how we manage agricultural risk. This is a joint session between the ARA and Extension tracks, so big welcome to everyone watching. Let me take a minute to introduce myself and the other speakers today. I'm Dr. Julia Borman. I'm a senior scientist with ARA Worldwide in the Research and Modeling Department. I'm the model manager for our U.S. multi-peril crop insurance model. Today, I'll be looking at the growing season and modeling efforts from a private markets industry view. And then we'll have Dr. Ashley Hungerford, a senior economist in the USDA Office of the Chief Economist, who works on domestic agricultural policy. Ashley's going to be giving us her perspective on doing disaster estimates during the growing season and how those results are communicated to different parties, giving us a nice overview of the hurricane insurance plan that came to the U.S. crop insurance program this year. Then we'll have Dr. John Newton, chief economist from the American Farm Bureau, which is the largest general farm organization representing farmers and ranchers in Washington, D.C. He's going to be looking at the adequacy of current safety nets, recent disaster payments, the 2019 prevented planting, and also looking forward to conservation efforts and resulting impacts on crop insurance. And then at the end, Dr. Keith Coble, Special Assistant to the Vice President and Department Head at Mississippi State University and our AEA past president, will wrap us up as a discussant. So after the presentation, we'll have time for questions, so looking forward to a good discussion. So for my portion, I'm going to focus on the private markets industry view, specifically how we use models throughout the growing season to understand risks in the crop insurance market. Okay, let me start by introducing ARA Worldwide for those who have not heard about us. At ARA Worldwide, we focus on high impact, low probability events, things like hurricanes, earthquakes, pandemics, and agriculture. For agriculture, we have multi-peril crop insurance models for the US, Canada, China, and India markets. We also have single peril hail models for the US and Canada. We have a fund designation service in the US market, and we also have a web app tool that focuses on producer level risk. Models that are built by the research group are packaged into AIR software platform, mainly Touchstone Re, and then used primarily by reinsurers. So the models work to satisfy common features, bringing in physical properties data, including precipitation, temperature, soil data, crop growth data, looking at the impact on yields, leveraging AIR severe thunderstorm catalog to understand things like hailstorm probability, and looking at long-term crop yield trends from weather variation and fundamentally driving our models by weather to describe correlations across crops, time, and space. So our models can be used for a wide variety of applications, mainly enterprise risk management, pricing and actuarial work, underwriting, fund designation in the US MPCI market, claims and risk transfer. So I want to take a second to look at the reinsurance side of the US multi-peril market. So in the overall ecosystem, reinsurers are the ones who are providing insurance to insurers. They write the contracts and the negotiations usually happen late winter through early spring. Most of the work is done around February and March. An important feature of the contracts is that whether excess of loss or quota share type of negotiations that are happening, a lot of them can attach at a loss ratio lower than 1. So for any given reinsurance cycle, the reinsurers typically have to evaluate the risk on any particular book of business, and then throughout the growing season, how they can understand that risk given the current conditions that are happening. The AIR model approach is to build 10,000 potential outcomes for next year in what we call a catalog of events. The catalog gives a view of the risks already experienced as well as events outside of that experience to build a better understanding of tail risk. For the US MPCI model, we explicitly model 17 different crops, which means we model the yields and prices for those crops directly by incorporating temperature, precipitation, soil data, and crop growth stages to estimate the effects of weather on yields in a water use model. All the other crops in the program are then modeled statistically. We also have 4 separate catalogs in the US MPCI model. They vary on price outcome only. These catalogs are representative of different implied market price volatilities, the variable which dictates premium rate per acre on revenue protection policies in the US MPCI program, and is the market indicator of expected swings between projected and harvest prices for a given crop. So on the left is a graphical image of the AIR national catalogs for corn. On the x-axis, we have the yield ratio, which is a percent of average catalog yield. And on the y-axis, we have the price ratio percent, so the harvest price divided by the projected price. Observed events from 1974 to 2017 are in the orange squares. The low catalog has the tightest spread on price outcomes, representing a low volatility scenario. So you can see that hugs the observed points quite closely. Historical catalog is representative of average price volatility over the observed period. And then the medium and the high volatility catalogs have larger price spreads for larger volatility measures. So at the beginning of each season, the private market typically asks 4 major questions, which are what are the volatilities that were set in price discovery, and which catalog in the AIR suite of catalogs represents that. They also look for early indicators of production stress, namely, is it too wet or is it too dry in an obvious way somewhere that might be driving yields even early in the season. They look at big premium shifts from one location to another, and then also how much premium rates have adjusted year over year. So these questions have become very standard, and for every season, right, we check these 4 boxes and look at what's changing year over year, but what's not necessarily standard in our conversation is what follows. So what drives the conversation each growing season is very different. So here, what I've done is I've pulled the major events that have happened since 2012. So in 2012, it was a drought. 2013, conversations heavily at harvest were about the government shutdown and what that was doing with acreage reporting and price fluctuations. In 2014, there was a large production. There was a lot of talk about the subsequent price drops that happened from that. 2015, we started with tropical storms. We also had high yields, but we had higher prices than we did in 2014. 2016 was a great year in terms of loss ratio. So we had strong yields. Corn prices dropped to a price ratio below 1, but soybean had a price ratio above 1. So the industry had amazing results that year. 2017 was characterized by natural disasters, hurricanes, wildfires in California, droughts in the Northwest. 2018, we spent our time talking about trade wars and what that did to prices and stocks. And then in 2019, we talked about prevented planting, impacts of prevented planting on yields. And for 2020, we have coronavirus. So for each year, things are very different. They're almost always new, or they're in a different pattern than they were previously. And so for these conversations on our side, we typically break them down into either more of a production side issue, so what's going to happen with the yields, or a price side issue. And these 2 things are not distinct, but when we want to look at major impacts from any one event, that's usually how we break them down. So then the question is, what can a reinsurer who's using our model do during the season to understand the impacts on their book of business? So, the first thing is, how do we communicate what's going on? So we have a service called Crop Alert that we use to do this. It's a monthly newsletter and reports on information from a wide variety of sources. We're looking at government publications, we're looking at local news and Twitter, looking at reported weather. We're looking at the futures market in the US to understand what's going on with the futures prices. And we're bringing that all together. along with another major component, which is we use our yield model for corn and soybean, and we run current growing season weather through that to evaluate what's going on with the yields. So what we do there is we take the current growing season weather up to the last reported date that we have and process it along with average weather for any missing day in the growing season. And then we use that to develop a deviation from baseline yield. Baseline yield is set with average weather. And then we give the clients a view of the yield risks that are developing. So here's an example of how this works and how the model sort of fundamentally functions. It's a water balance model. It considers temperature, precipitation, soil moisture levels, and where in the crop growth cycle we are. It then creates a deviation that indicates if the weather has been favorable or detrimental to yields. And we use this deviation applied to our baseline case and report those yields monthly for key states and at the national level. So once the clients have those expectations from the yield modeling, and they've also looked at what's going on with the futures prices, we can subset our catalogs. And if we have a client, they can do that within their software. So a reinsurer could run a particular book on a subset of events and get a loss ratio that satisfies those current growing conditions. So on the left here, I've shown what we've reported so far for June and July. So you can see that the yield ratios have been close to average in our model, so near 100%. But the prices, especially for corn, are indicating low price ratio outcomes. And then on the right side, you can see that national corn catalog. So what I've done is gone in and drawn the corn estimates from July in orange, the orange lines, and then use the light color box as a representation of the subset that a reinsurer might consider when trying to understand what's going on so far in the 2020 season. So what if subsetting is not enough? This has happened, and it happened last year with the record prevented planting. So once we subset the catalog, the particular events that fit the yield and price scenarios did not have considerable prevented plant on them. So on the research side, what we did is we generated the scenarios for the industry and adjusted the claims, and then recomputed what gross and net loss ratios would be. And then these get delivered via crop alert over so that reinsurers can understand what's happening. So beyond giving a loss ratio and determining the risk in any one year, the other thing that reinsurers want to do is that they want to see, how does that compare to their EP curve? What is the return period on any given event or for this year? And also compare that to historical outcomes. So at AIR, we have the EP curve that comes from the catalog, so we can benchmark any one year against that. We also recast the years 1974 to 2017, which means that we take the actual yield and price outcomes and we determine losses as they would be under the current program. And then we put those on the EP curve as well. So here you can see for 2019, we have a 1 in 6 year event. So that's what the prevented planting did in that particular case. We can compare that to some of the major droughts in our historical observed experience, 2012, which is about a 1 in 10. 1974, which is about a 1 in 15 year event, versus 1988, which comes in at a 1 in 27 year event. So that's it for my section. Thank you for your time. Let me turn this over to Dr. Ashley Hungerford.
There we are. Hello, I'm Ashley Hungerford, and thank you, Julia, for the introduction. Today I'll be discussing disaster estimates produced by the USDA. These are internal estimates that we give to high-level officials as well as occasionally to policymakers outside of USDA. This is something that we've seen a lot of interest in the causal loss data for our crop insurance indemnities. And this is available online now, and we see people wanting to create disaster estimates from it. And so this kind of gives a broad overview of how that can be done. Granted, when I work with RMA and we create these estimates, we're able to get a finer resolution of data, but it's still the general principles apply. And we'll also be looking at the hurricane insurance plan, which came online this year for sale. This also includes my little disclaimer, being a government employee, have to include that. Also, people that have also helped with this, Chris Oliver from RMA, I would like to mention, as well as Thomas Worth, who's a senior actuary, and then also my boss, Rob Johansson, who is the chief economist at USDA. Okay, so what does the US response look like, or USDA response look like to a natural disaster? Typically, it's going to start with meteorology reports coming from the OCE Meteorology Department. We're going to look at NASS crop conditions. These are coming out weekly during the growing season at a state level as well as national. We establish a baseline for the crop damage. We're going to typically be looking at revenue losses for crop. So not including some of the other items that we see external estimates sometimes include. And then kind of moving on from that, again, we had a directive, or by we, I mean RMA, and the 2018 Farm Bill to develop a hurricane product. This is the impetus of this being the ad hoc disaster assistance that came following the 2017 hurricane season. So we'll talk about what that plan looks like, as well as some of the data we see in the summary of business. Okay, again, we start with some early monitoring of storms, and this is very high level. You wouldn't be able to get much of a disaster estimate out of this. This is looking at Hurricane Dorian from last year, which, as you may remember, didn't have a strong impact on the continental US compared to perhaps the last few years, or 2017 and 18, what we saw some damage in South Carolina. But at this point, on August 30th, which is when this snapshot was taken, we were thinking it was going to hit Florida, so we were really exploring all the possible areas and crops that could be affected by this. Okay. And in the event that we do see a storm, typically the first thing we look at afterwards is going to be the NASS crop conditions, as I mentioned earlier. Hurricane Florence happened in 2018 and affected the Carolinas. And we see the NASS crop condition for the Carolinas for cotton. And we see on the bottom, Alabama and Georgia cotton for Hurricane Michael. So if you're not familiar with how NASS crop conditions work, again, it's a weekly measure. It's a very subjective. The finest resolution that we can get is at the state level. And it's just going to divide up the crop into 5 categories, very poor to excellent. And while this gives us a before and after of what happened in these events, so again, Florence happening about week 37 in 2018, and Michael happening week 41 of 2018. Generally, it's not going to give us a measure that we can use empirically. At least I've tried, and it hasn't been very pretty. So we typically keep this as a qualitative measure. One of the most important things probably in establishing a crop damage estimate is creating a baseline. And so we're sticking very much with the RMA framework, or the crop insurance framework, sticking to actual production history for yields. So we aren't going to be including things like bumper crops, which we saw particularly in Georgia with cotton in 2018 and Hurricane Michael. Depending on the timing, we're going to be using projected prices or harvest prices coming out of the crop insurance program. So this is going to be based off of futures. This doesn't account for basis. So any basis, particularly we saw some widening basis after the trade dispute in the Dakotas, so that would not be reflected in these estimates. Also, we're only looking at direct loss, in particular crop revenue loss. So we're not looking at this through the lens of an in-plan model where you're looking at regional economic effects. So nothing affecting upstream or downstream and agribusiness. Also no future crop losses. So if we're looking at damage to a tree or bush, we wouldn't be discounting crops in future years, and no foregone income. This is particularly mentioned to program payments such as the 2018 Market Facilitation Program, which is based off of production. So any income that was not given or received due to that event would not be included in our estimate. Okay, we kind of divided up into a few different bins as far as making sure that we're looking at the full picture. So we're going to look at those that receive a crop insurance indemnity, those that experience a shallow loss, the uninsured with a loss. I'm also including those with NAP policies, the non-insured crop disaster assistance program here, because we don't have crop insurance data for them. Exposed but no loss, and then finally just not exposed because it's already been harvested. So taking that all into account to really get a full estimate. When I've talked to some people in the past who are trying to use crop insurance data to create an estimate, they often forget about the shallow loss component or not accounting for uninsured. Okay, I'm going to skip through some of this because it's getting a little dense, but just a general overview. We're kind of using an expected, or we are using an expected value approach. We're looking at the frequency of claims that we've seen in the past and a percent loss based off of either incoming indemnity information, and if we don't have that, then we're using historical indemnity information from that area that has experienced, hopefully they didn't experience a natural disaster, but a similar event that we can draw reference to. And we're also, again, looking at the losses qualifying for crop insurance indemnity payments. We're going to be looking at whether it was in field or not. So we're taking that information typically from NASS where it's provided. If it's a small niche crop, some specialty crop that we don't have a lot of information on, probably just using documentation on crop season. For the shallow loss, we're using a similar approach. Again, the assumed shallow loss is going to include all that information on crop value. It's just that this assumed shallow loss would have to be in that producer deductible range in the policy. And what we assume for a frequency of shallow loss, well, that's going to have to add up. So to 100% when we also add that with the claim frequency. So who's getting a crop insurance indemnity as well as those that have no loss. From this, we're able to extrapolate on uninsured losses. So that includes those that don't have insurance for a crop that is insurable. So if you're talking about corn in Champaign County, and maybe there's one producer there that doesn't have insurance, we have to extrapolate based off of market penetration rates coming out of NASS planted acreage or from their survey or from the Census of Ag. And if it's a crop that is covered by NAP, so a non-insurable crop, then we're going to try to look for a similar crop that may have experienced similar damage in order to extrapolate what the losses would be to the non-insurable crop. Okay, just kind of an interesting point on hurricane indemnity progression. So if we're looking at 2017, which started with Harvey, but I would say Hurricane Irma is really where we saw citrus being affected in Florida. We look at the reported indemnities going out and you see it's pretty linear. And from when the events first took place. And a lot of that is just due to the fact that citrus harvest can go all the way out into May of the next year. Not necessarily, but somewhere between November and May. So it can take quite a while from the event to actually placing an indemnity or receiving an indemnity because the crop hasn't been harvested yet. In 2018, Hurricane Michael and Hurricane Florence primarily hit field crops. And it was around the time, maybe the event happened slightly before harvest or a month or two out from harvest. And we see that from that, a much quicker indemnity progression. But it kind of raises the question, or it does raise the question, we know this event happened, and we know that we're going to see losses from it, but because of the claims process, it will take a while for indemnities to go out. And also there was a demand for a higher coverage level. So we've seen ad hoc assistance happen recently in the last couple of years, but this takes a lot of time due to supplemental appropriations. And then you have the rulemaking of the program and then implementation at FSA offices that are already being flooded with applications for other programs. So with this in mind was the development of the Hurricane Insurance Plan. So this is a very simple parametric product. So it's going to be triggered when a county or adjacent county experiences hurricane-forced winds from a named storm. This is an endorsement that is a complementary policy. It covers up to 95% of expected crop value. So you're going to top this on top of a revenue protection product or yield protection or an APH product. It covers a lot of different crops. So this is available for your field crops, fruits and veggies, as well as nursery and tree products. It's going to come out fast as far as the indemnities. So losses are paid within 30 days of RMA releasing a list of counties identified as being affected by hurricane force winds. So this means that you can quite possibly receive the indemnity from this endorsement before you would receive the indemnity from the rest of your policy or the underlying policy, such as the revenue protection policy. Its subsidy rate is 65%, so it's the same that we see for this supplemental coverage option, which is, again, an area-based plan. And I do want to mention, I think, sorry, just sales closing was April 20th of this year, but going forward, it's going to line up with the same sales closing date as the underlying policy. Okay, looking at what the earned premium rates are, so this is where we've seen buy-up occur for this endorsement. It can be pretty pricey as far as if you're in an area that's affected by hurricanes, the premium rate will reflect that, and it can be up to 35% of an earned premium rate. So again, what that means is this is total premium divided by liability. Again, that's not including that subsidy rate, which is 65%. So that would, of course, bring that premium rate down from the farmer's point of view. Oh, sorry, a little technical difficulty on my part. Okay. Where we have seen a bit of buy-up is in the Carolinas. We also have seen some down in southwestern Georgia. It's a little hard to tell down in Florida, but there has been some policy buy-up as well. I will say that this is a summary business from August 3rd, so policy data is still coming in. Okay, looking at liabilities, this map shows up to 12.7 million in liability per county. Again, a lot of that happening in the Carolinas, although we do see the highest on this map occurring in Texas. I left out Miami-Dade because actually that county has 41 million, so it completely skewed the map towards that higher end and didn't show much color contrast. Okay. This is just looking at the 2020 crop year. A lot of those specialty crops would, I believe, be in 2021. But we see a lot of liability in those southern field crops. So cotton, peanuts, tobacco, rice, as well as corn and soybeans. We do see some of the specialty crops in here already under blueberries and pecans. But as of August 3rd, it was at almost 400 million in liability. So conclusions, estimating disaster losses, it's still hard. It's still going to be quite a task. It does help a lot. I didn't quite talk about when we coordinate. Obviously, I'm coordinating with RMA, and we coordinate with Farm Service Agency as well, and outside the government with our partners and the universities and state ag departments. It's It's really amazing, the new parametric product that RMA has developed, how quickly indemnities can come out after a hurricane, much faster than what we are able to see with ad hoc assistance. And then a bit of an update. So previous slide, I said it was about 400 million in liability. As of August 10th, it was at 456 million for crop year 2020 liability for that hurricane insurance plan. Okay, and that is all I have. Thank you so much for listening. I appreciate it.
All right, good afternoon. I'm John Newton. I'm the Chief Economist for American Farm Bureau Federation. And I'm going to speak today about the adequacy of existing risk management tools, in particular crop insurance and farm bill programs that we authorized in the 2018 Farm Bill. When we think about the risk management tools that are available, I think farmers across the country primarily depend on crop insurance. That's one of the key risk management tools, in addition to the protection through ARC and PLC, as well as your dairy margin coverage programs that are available in the Title I of the Farm Bill. But in particular for crop insurance, every year farmers spend billions of dollars to protect against catastrophic losses or damage to their crops, weather-related damage, things of that nature. And in 2019, we saw $10.2 billion in premiums were paid in for crop insurance. And in 2019, after a pretty devastating prevent plant year, after a pretty devastating flood environment that impacted portions of Iowa, Nebraska, Missouri, as well as heavy rainfall across parts of Iowa, Indiana, Ohio, we saw very significant indemnities go out in 2019. So 10.3 billion in indemnities to farmers this past year. That's the highest level that we've seen since 2013, when we were coming out of the high price environment of 2012, with the harvest price option really kicking in both in 2012 and 2013 on some of your Midwestern commodities. If we look at 2018, prior to, I think, many of the headwinds that farmers have been facing in recent years, I think you look at the use of crop insurance, over 197 million acres for revenue protection for 15 crops. So that's 2/3 of our crop ground had revenue protection policies in 2018. And that was really designed to protect against adverse weather events, things that are going to lead to a crop loss or a revenue loss for that particular producer during the growing season. And I think, who knew the world that we would actually find ourselves in 2018, 2019, and 2020 that we're in now, these unprecedented black swan events. And I think the first one that we noticed was, as we were renegotiating trade in many of our top markets, China in particular, with respect to the Phase 1 agreement, retaliated on 99% of U.S. agricultural products. And I don't think crop insurance was ever built to withstand retaliatory tariffs that take a significant amount of demand off the table. Chinese purchases of soybeans from the United States fell sharply. As a result of that, we saw stocks increase and prices decline. And crop insurance really can't protect against price declines that happen during the marketing year. They can protect against declines that happen through the growing season. But once harvest is complete, crop insurance no longer provides much support. And farmers do have Title I programs, but in the case of soybeans, their support level was very, very low and did not trigger much support to help those producers impacted by the retaliatory tariffs. Then, after the trade environment, what we saw again is we continued to face those trade headwinds in 2018 and in 2019. The retaliatory tariffs remained in place. Matter of fact, remain in place still today. Our exports fell in 2019. Imports continue to rise, and we saw agricultural's trade balance fall to 5.6 billion. That was down nearly 50% from 2018, and the lowest in 40 years. As a matter of fact, this year, this calendar year for 2020, we're on pace to have the first negative trade balance for agriculture in over 40 years. And that's because of the headwinds that we face on the trade front, and then obviously this unprecedented event that we're dealing with now with COVID-19. But again, crop insurance was never designed to protect against these type of unexpected disruptions to supply and demand. It was primarily built to protect against weather-related crop losses. When we look at what happened, because the farm safety nets really weren't designed to address these retaliatory tariffs that impacted more than just your traditional row crops. We had pork producers impacted, livestock producers, dairy producers impacted. We saw the administration initiate 2 ad hoc disaster programs, one in 2018 and one in 2019. Over the 2-year period, some $20 billion in direct payments were made to producers on top of traditional farm program crop insurance payments or Title I payments. So we saw, MFP payments were the highest across the Corn Belt, along the Mississippi, up in the Dakotas, and then down into the Texas area where a lot of cotton is produced in the country. Again, these ad hoc disaster payments were made to offset the damage to farmers and ranchers as a result of unfair retaliatory tariffs that quite frankly, again, crop insurance wasn't designed to protect against. And then you think about what happened last year. I took this picture when I was driving in Indiana last spring. Unprecedented weather event, historic rainfall across the country, ultimately prevented a lot of farmers from being able to get a crop in the ground prior to the deadline. And so what we saw last year, as a result of that, we had disaster declarations across the country. In addition to the hurricanes that we had come up the East Coast and up the Gulf of Mexico, the value of agriculture, the combined value of agriculture across all of these districts that had a FEMA-declared ad hoc natural disaster was $154 billion. So Congress had to work quickly to get a disaster package, both in 2018 and 2019, to help producers that were impacted by these adverse weather events, these hurricanes, wildfires, and in this case, flooding. Because growers couldn't get a crop in the ground, crop insurance does have a feature called Prevent Plant that will indemnify a grower at roughly half the spring value of the crop insurance policy, half the revenue guarantee. So we saw 20 million acres filed for Prevent Plant in 2019 due to the historic flooding that we saw across the country. And we hadn't saw anything like that before either. The highest Prevent Plant before that was probably somewhere in the neighborhood of 10 million acres. So this was quite a significant increase in terms of farmers not being able to get a crop in the ground. You had 11 million acres of corn filed for Prevent Plant. I believe you had 4 or 5 million acres of soybeans filed for Prevent Plant, cotton acres filed for Prevent Plant. But again, we had never seen anything like that before. So the second disaster package, Congress passed the first wildfires, hurricane, and indemnity program in 2018 after hurricanes and wildfires had devastated agriculture. We passed the second one in 2019. It was called the WIP Plus program, which provided farm disaster assistance of an additional $3 billion. And so you saw, in addition to, again, the Prevent Plant insurance and crop insurance and Title I programs and MFP, now you also saw ad hoc disaster assistance going out 2 consecutive years in a row. And in 2019, the disaster package was used to do something a little bit different. It was used to not only do WIP eligibility for 2018, 2019, and here you can see the counties where we had natural disasters in 18, natural disasters in 19, and then where we had natural disasters in 18 and 19. So those counties, producers were eligible for WIP payments, but the disaster package also included a new top up on Prevent Plant, which was a bonus payment to producers that were unable to get a crop in the ground in 2019. Growers, if you had a RP policy with harvest price option, you were eligible for 15% bonus payment on top of the prevent plant indemnity. So in the case of corn, your average prevent plant payment would have been $252. The top up, which came out of disaster package, added $38 an acre to that prevent plant claim. On the same for soybeans, we were looking at a total payment of around $220 an acre, which included the traditional $192 on your prevent plant claim, plus a top-up payment of $28 per acre. So we've now introduced ad hoc disaster recovery on top of crop insurance. And so we're starting to see a theme here that potentially our risk management tools that we have in place may not be adequate enough to deal with some of these recent trade and weather events that have occurred. And then, wow, comes 2020. I think folks were finally looking forward to getting trade friction behind them, looking forward to a better growing season. And then in March, COVID-19 hit and really devastated demand for U.S. agriculture. And I can tell you that crop insurance and Title I programs weren't ever designed to deal with a once-in-a-lifetime global pandemic. So now, when you think about the implications of that for agriculture, more than half the food in the United States was consumed outside of the home. So you had immediate supply chain disruptions, growers that lost a market for their product and had to plow it under, growers that lost sales and had product rot on their farm, farmers who had nowhere to go with their milk and had to dump the milk, or farmers who had market-ready livestock without any processing capacity. So in response to the coronavirus, in March, the CARES Act was passed, stimulus package. It was a $2 trillion stimulus package, but it included $9.5 billion to the Office of the Secretary, as well as $14 billion for Commodity Credit Corporation replenishment. So a total boost in direct payment capacity of $23.5 billion that was used to craft assistance payments for farmers this year to recover from COVID-19. There are conversations ongoing now on the next stimulus package. The Senate's proposal would boost the Secretary's capacity to deliver direct payments by $20 billion. The House has a similar, in their HEROES Act, has $16.5 billion to go to agricultural producers, and a couple of other provisions that brings their ad hoc support up to nearly $33 billion. And so once this next stimulus package is passed, likely in the coming month or so, we'll have seen ad hoc disaster payments go out to farmers in the form of 2 trade packages, 2 disaster aid packages, and now 2 coronavirus stimulus packages. What that does, and if you look at where we are currently in terms of this latest ad hoc disaster support, a lot of that money, again, is concentrated in areas where growers were impacted by the coronavirus. Iowa, with its livestock intensive hog operations, cattle feeding operations, and then the corn and soybean production in that state, they lead the country, nearly $700 million in ad hoc payments as of now. There's still still 1 month left for producers to sign up, and new commodities were just recently announced for eligibility, including aquacultural producers who don't have much of a federal safety net at all. We had egg producers without a federal safety net impacted, contract poultry growers who saw the number of flocks they receive every year reduced. So there's all segments of agriculture have been impacted. So we're likely to see more ad hoc stimulus go out in the coming months. And if you put all this together and look at the role of federal payments to producers over the last decade or so, you can see the step up that really occurred in 2018 as we started to deal with retaliatory tariffs and the trade war. 2020 was this is the first round of coronavirus assistance, and then 2021 includes this next fiscal year payments includes $14 billion in CCC replenishment, as well as the $20 billion that the Senate may include in their HEALS Act. So you can see an increasing role in federal support to help agriculture deal with these unprecedented and unexpected weather, trade, and pandemic events. And so where do we go from here? How do we make the safety net more robust for farmers and ranchers? There's a conversation about trying to reconsider whether the support provided in the 18 Farm Bill, especially under Title I, is adequate for the current pricing and income environment that we find ourselves in. So lawmakers will be deliberating that in the coming years for sure. But one thing that I think is gaining more and more traction, by the day almost, is the role of agriculture in the climate conversation. And if you look at total greenhouse gas emissions in the United States, agriculture represents about 9.3% of total emissions. But there's something unique about agriculture relative to these other sectors, and that is agriculture has the ability to capture carbon in the soil, to turn animal waste into energy sources. So agriculture has the opportunity to be a carbon sink. And I think we may see in the coming years an effort to boost things like cover crop and think about how cover crops and conservation programs can be incorporated with crop insurance and Title I risk management tools. We need to do a lot more studying on this. We need to know how the use of cover crops on a farm impacts their APH, impacts the revenue guarantees under crop insurance. How does it impact their yield performance? How does it impact their farm's liability, as well as all of these other conservation practices? So I think additional studying on these new efforts around conservation and the intertwined or connectivity of those and crop insurance and Title I is going to be a conversation to be had in the coming years. But it's certainly one that I think when you think about the investment community that's investing in ag land, when you think about the administration in particular, the Biden administration, their proposal is for agriculture ultimately to be net zero emissions by 2030. So really using the CCC, the Commodity Credit Corporation, to boost conservation spending, whether it's paying farmers to implement conservation practices or providing technical assistance or financial support. I think we could see an expansion of the CCC used to implement more conservation practices, help farmers offset the cost of implementing these carbon sequestration efforts. And ultimately, I think carbon will be something that one day becomes an income stream on the farm. But I think we can think about the Farm Bill, and it could potentially be used as a mechanism to get to that ultimate goal of agriculture capturing carbon and being part of the climate change conversation. So with that, I appreciate the opportunity to be with you and look forward to questions.
Okay. Well, thank you for the opportunity to be the discussant in this section and three really good presentations in front of me. So in addition to being able to look at these presentations, I have thought to try to bring some of these themes together in this conversation. Beginning with Julia's presentation at the beginning, and it's always interesting to see what Air Worldwide brings to the conversation, because they're in a unique space working in the reinsurance area. We tend to have conversation about farmers and conversation about the federal government when we talk about crop insurance, but this reinsurance role is really essential, and it has become more essential over time. And I suspect that it will grow even more important as we move forward. The ability to provide reinsurance so that we can have a more robust insurance availability is really something very, very important if we're going to continue to make progress with ag sector risk management. A couple of things that I'll note is, first of all, I see an evolution in the AIR models in terms, in particular, trying to deal with price risk and trying to deal with some of these, unique circumstances that have happened to us in recent years. In Julia's presentation, what really caught my attention is something that I think a lot of us ought to be spending more time to work on, and that is it's one thing that prior to the crop season to estimate yield variability from past data or estimate price variability from what the futures market is saying or some other mechanism. But understanding the nature of the resolution, let's focus on yield risk for a moment. Within the season, I think is an area that we've talked about for a long time, but I think it's really important is that, you know, how much yield risk is there in the state of Iowa on July the 15th versus July the 1st? And one of the things that I would suggest that we need to be thinking about is that probably economists ought to be talking more with agronomists who understand the physiology of plant growth and the resolution of the uncertainty about that crop as the season progresses. I will tell you all, I'm not a very big fan of yield models that are conditioned on weather that simply use total weather, total rainfall, average temperatures, or monthly during a season. I think we can do better than that, and I commend ARA for trying to work in that space. Moving on to the presentation by Ashley Hungerford. I know enough about what they do in the Office of the Chief Economist to know that this has just been a kind of an insanely busy few years for them with all of these trade negotiations, extraordinary weather events, and then the COVID-19 events. And you know, that's such important work that is being done in that office. And you know, one of the things that I appreciate is their attempt to quantify when there is a disaster, to quantify the value of the crop relative to an historical average APH yield versus a number that in a disaster event often gets inflated. And I'm going to come back to that point a little bit later on, but I think it's really important. I think also that a lot of the efforts to quantify disaster losses is far easier in row crops because we have a robust crop insurance program out there to provide us data and guide the decision making. But we still have this challenge with specialty crops in terms of what is the price risk in a crop that doesn't have a futures market? What's the revenue risk in a market that quite likely has a price yield correlation, but it is so difficult because of varieties and various factors to deal with specialty crops. Not that anybody wants to leave specialty crops behind, but rather they simply pose a number of challenges that traditional row crops do not. And so it's an area for further work for us to do. Finally, with respect to Ashley's presentation, I'm really fascinated hurricane insurance product. It's an index product. It has the potential for timely payments. I think this poses a really great opportunity to consider a standing insurance program versus trying to do ex post ad hoc kind of damage estimates. And after having some severe hurricane losses a few years ago, to come up with this product seems to me to be, in many respects, from an economic standpoint, a step forward in terms of accuracy, in terms of timeliness, to get a payment to the people who have actually suffered loss at the right time. The challenge will be, I'm now that Ashley has presented this, I'm going to keep a close eye on this product in terms of whether the specialty crop growers are going to buy into this product. So it looks to me like a pretty significant uptake among traditional row crops. I saw some, but I didn't see a lot of participation from specialty crops that were damaged in Florida from a few years ago. So I think that one certainly merits watching going forward. John Newton, I always commend John for having the best looking graphics of anybody that I know, and I appreciate that. You know, he talked about revenue insurance and the growth of that program. I guess I have to admit I was old enough to be around when revenue insurance started, and we really, I don't think very many people really did expect the program to grow and be as popular as it was. I think it, in part, acknowledged the recognition that many producers saw, which was for certain crops, particularly corn and soybeans in the Midwest, that there's a negative price yield correlation. And that makes a product based on revenue make a lot of sense. John also talked about prevented planting issues in 2019. And I have looked very specifically at the problems that we had in Mississippi. And there were some truly devastating situations that went on in that year. And, you know, we talked about black swan events, and we have, to be honest, I think if you look at a long enough historical record, that in agriculture, we have been going through a period where we had remarkably good prices and remarkably good yields for a number of years. And I'm not trying to discount the black swan nature of some of the things that have happened lately, but this is a situation that we've been in the last few years that has in different forms played out before. Low commodity prices it is a big one, regardless of the reason why. And I think we're going to continue to be talking about that going forward. John brought up conservation in Title I, and I think that's an intriguing question. There have been a number of efforts. I can remember during the 2014 Farm Bill, the efforts to create cross-compliance between crop insurance and conservation activities. I think it's very possible that we are going to be having a lot more of those conversations going forward. I have a paper that's in review now with a former student of ours that was really a survey of the general population of the United States. And certainly there was a desire to see funding in conservation programs. But the devil is in the detail, and as we try to do these kind of things and make an interface work. And I think that there's those possibilities. There's also the possibility of doing things in conservation that may be a clearer signal and incentive for people to do conservation activities. So let me wrap up my part of this program by throwing out a few things. I've already alluded, as many of the speakers did, to ad hoc programs that we've been doing in recent years. And John had a slide that really showed the degree to which that has increased in recent years. Again, showing my age, I was working at USDA in the early 1990s, looking at the ad hoc payments and the programs that we had in the 1980s, year after year, of ad hoc programs that in general were poorly timed and not delivered, not targeted particularly well to the people that actually had losses. The additional subsidy and the development of the federal crop insurance program was really meant to overcome that. And we went through a period where we didn't do much ad hoc disaster programming in the United States. And now where I have to assess that we're at today is that we're now doing both. We have a large scale crop insurance program and we're doing a lot of ad hoc payments. I think there's an argument that can be made that we've had some events that were not going to be protected by crop insurance, and I think we can recognize that. What we probably need to talk about a little bit more is the fact that with our Title I programs, we've seen a significant shift away from ARC towards the PLC program. And the question can be asked, to what degree are we overlapping and double indemnifying in some cases, and then leaving other risks unprotected for the producers? And we're kind of back to a world that we were in before the ARC program came along, where we have these standalone programs. I think that begs the question of the degree to which our Title I programs are tied to base acres and are truly decoupled from planted acres. And I had an interesting conversation with a farmer not too long ago who vehemently argued with me that the Title I programs truly were decoupled, and that he looked at his Title I payments in the aggregate at the farm level, and he in no way was going to assume that those payments were allocated out across commodities. So to what degree are they a risk management tool for a particular crop versus at the whole farm level? I think there's going to be a lot of exciting things for us to work on in the area of risk management. As John alluded to, risk management and conservation could be a very exciting area for the next several years. And I will end by putting in a plug that probably one of our greatest hindrances in terms of being able to answer some of those questions is the lack of data, and finding a way that we can analyze the data and really get enough of a significant time series that we can assess the probabilities of certain events accurately. So, great set of papers. I really appreciate being a part of this session, and I will end there.